if we're at $300 silver in 2 months' time, I'm not going to sell my silver. I'm going to hold on to it. Rick Rule is selling some of his physical silver. Silver's trading around $100. I think today it's sell about 101 on the Shanghai Gold Exchange. It's a real physical market in the Middle East, Far East, and in India. There's no way that the price in London and New York won't catch up to the price in China or even India.
The continually raised margin requirements from the CME.
It helps the bullion banks because they're mostly short. I think the big guys, governments and central banks and sovereign wealth funds, they're going to have access to silver before retail. Gold and silver were doing well anyway prior to the announcement from the DOJ. Trump has been pressuring Powell, but the bullion banks are going to be losing more and they're going to have to pay more.
Do you think it might be a good idea to start shifting from silver into gold at the moment?
$90 silver, that's worth 65 fiat dollars. Do you really think that's going to go back to being like one fiat dollar? I don't. If anything, next year when I'm speaking with you, that's going to be worth maybe 100 and let's say 50 fiat dollars. So yes, I heard that Rick Rule is selling some of his physical silver, but he's going to buy silver miners. So, and in that sense, I agree, because the silver miners are heavily undervalued versus silver. And I'm sure Rick Rule has a lot of physical silver, so it's not like he's going to get rid of all of it. But for us smaller investors, yeah, I would hold on to my silver unless there's an emergency. And I would also continue to stack as much as possible, because I hear that the U.S. Mint as well is limiting the supply that it mints of silver coins, and other mints as well around the world. So I don't think it's going to get better.
There definitely has been a slight issue with supply at the moment, getting certain products and seeing delays. And a lot of people at the same time are selling back at the moment. We're seeing huge delays on processing times there as well.
The quiet tale here isn't silver's price. It's how badly fiat math is distorting investor judgment. This part exposes a disconnect most headlines ignore. Even at $90, silver is framed as expensive, while purchasing power keeps eroding underneath it. As Mario Innecco has pointed out, investors often anchor to nominal prices instead of real value, which is why supply signals like US mint production limits matter more than spot charts. Rick Rule rotating into miners isn't bearish. It's a valuation arbitrage. Meanwhile, retail delays and buyback bottlenecks quietly confirm stress in physical supply chains, something futures markets rarely price correctly. For small investors, this is about optionality, not flipping trades. And what Mario Innecco flags next reveals why liquidity isn't as available as it looks.
Well, as we move into higher inflation, all of that, what do you think the availability of retail product will actually be? It seems like whenever we see a rush towards retail product, there's only so much there. So it seems like there could be major issues going forward.
I think so too, especially for retail, like you say, because the whole world, especially governments around the world, are realizing how important not just silver, but all natural resources are, and how the supply chains are being disrupted because we're not in a multipolar world anymore. So I think the big guys, governments and central banks and sovereign wealth funds, they're going to have access to silver before retail. So yeah, I think retail needs to realize that if they're sitting on the fence waiting for a correction, I think that's a bad strategy. I think dollar cost averaging or exchanging fiat for real money whenever you can is the best strategy.
In 2026, in 2025, we saw a huge rally in both gold and silver in nominal terms, but silver more than doubled. It's about triple from where it was last summer. So going forward here in 2026, some people are saying, well, we could see maybe not as dramatic of a rise.
The overlooked risk here isn't price volatility, it's access asymmetry. This highlights a structural shift where sovereign buyers and institutions move ahead of retail. A pattern Mario Innecco has repeatedly warned shows up late in commodity cycles. When silver triples in nominal terms, people expect a pause, but history shows demand often shifts from speculation to security. Government securing resources ahead of inflation cycles squeezes retail supply regardless of spot pullbacks. Dollar cost averaging isn't a slogan here. It's a response to uncertain availability. Investors waiting for textbook corrections may find product shortages instead. What Mario Innecco points out next reframes why slower gains can still mean higher risk.
But it sounds like you're thinking that things might really be heating up, especially when it comes to inflation. So do you anticipate a similar kind of performance in 2026 that we saw last year?
Yeah, I do. And it's not just because of inflation. It's because of the supply, especially with silver. I know there's a lot of silver in the world from past production, but it's in places that is really hard to get and recycle. But so right now, yeah, there's a desperate rush to get physical silver. There's a huge shortage. We've seen the mining supplies not match the demand for the last 5-6 years. And that's why I think the price of silver needs to go up at multiples in order for people who have silver to get rid of it so that people that need the silver can get some. I personally, unless I need to, am not going to sell my silver. I'm going to hold on to it. But some people might, if we're at $300 silver in 2 months' time, I'm sure a lot of them will sell. But it's difficult to say at what price, Elijah, things are going to balance out in terms of supply and demand. So yeah, it's not just inflation.
What's missing from inflation debates is how slow supply actually moves. This makes clear that silver scarcity isn't theoretical. It's logistical and geological. A point Mario Innecco has emphasized when discussing above-ground stock illusions. 5 to 6 years of mining deficits don't resolve with price alone. They resolve when holders are forced to sell. That's why price multiples matter, not forecasts, but incentives. For portfolios, this means volatility doesn't equal fragility. Holding through dislocations can matter more than timing exits. Mario Innecco's next insight explains why price balance may come later than expected.
And we've been hearing, you probably heard of this rebalancing of a commodity index, that it was going to crash silver. And despite that, silver's already up roughly 20% this year, and we haven't even finished January. Gold as well is up a few percent, so I don't think it's going to stop this performance. Of course, there will be some sharp corrections along the way, and you just need to sit through those, I think.
You mentioned not selling for dollars. A lot of people are looking at ratios. You've talked about the Dow gold ratio, something to keep an eye on there. The gold silver ratio as well has fallen dramatically over the last year. It was up around 100 to 1, and now it's around 50 to 1. So it's been cut in half. Silver outperformed by double. Historically speaking, if you go back more than 100 years, the ratio has been closer to 10 to 20 to 1. What do you anticipate there? And do you think it might be a good idea to start shifting from silver into gold at the moment?
Yeah, I mean, I always think of trying to get as much of both with my fiat.
This is where narrative control breaks down. Despite index rebalancing fears, silver's up roughly 20% before January ends, a stat that contradicts the crowded trade storyline. Mario Innecco has noted that ratio compression, not price spikes, often signals early cycle momentum. A gold-silver ratio falling from 100 to 1 to 50 to 1 shows leadership rotation, not exhaustion. Corrections will happen, but selling into fiat during a ratio reset historically destroys optionality. Investors should view ratios as signals, not timing tools. What Mario Innecco highlights next explains why this rotation may be unfinished.
So, but if people have a lot of silver and they've done really well and they don't have any gold and they want some exposure, why not? Get rid of some silver to get some gold. I don't have anything against that. But the other important thing about the gold-silver ratio is that you and I and others in this space have always been telling people that for you to have a real raging precious metals bull market, you need to see silver outperforming. And that's what we're getting. So this is, I think, in my opinion, just the beginning. And I don't know how long it's going to take. But if you look back to 1933 and 1980, when the credit cycle bottomed, the Dow gold ratio, in 1933 was 2 to 1, and 1980 was close to 1 to 1, and we're still just above 10 to 1, the Dow gold ratio. So I think there's still a lot of room in the precious metals bull market, especially relative to the stock market.
Definitely. And when it comes to around the world, what we're seeing for the demand for precious metals, I know you've recently interviewed King Kong.
The real signal here isn't rotation, it's confirmation of where we are in the cycle. As Mario Innecco points out, silver only leads when capital is quietly losing confidence in paper assets, and the gold-silver ratio collapsing from triple digits reinforces that message. Historical anchors matter. At prior credit cycle lows in 1933 and 1980, the Dow to gold ratio compressed far below today's levels, suggesting equities remain expensive relative to hard assets. This isn't about chasing upside, it's about recognizing regime change in capital preference. Investors trimming silver for gold aren't exiting metals, they're recalibrating exposure within the same thesis. What Mario Innecco highlights next explains why this ratio shift may still be early.
He goes by on X, I believe, and you have him on the channel quite a bit. An insider in Hong Kong, he has been talking about the different pricing of gold and silver in Asia versus London and the US. What is your perspective on that? How it seems like Asian markets are higher, and there's actually kind of an arbitrage opportunity. It seems like there's a huge demand right now for precious metals in Asia.
Yeah, China and India, they're buying a lot of physical silver. Also, the Gulf cooperation countries, which is like Saudi Arabia, UAE, Qatar, Bahrain, and Kuwait, they had a deal with China back in December of 2022 to cooperate in building their infrastructure, and it even mentions photovoltaics, which is for solar panels. So yeah, all these countries are buying a huge amount of physical silver. In the West, the LBMA and COMEX is more of a paper market, and I think that's why the price of physical silver in Shanghai is higher than the Western prices, because it's for real physical silver. And that's why the Chinese as well, they've put export controls since the 1st of January this year on exports of silver.
This isn't arbitrage. It's a referendum on market credibility. As Mario Innecco has warned, when Asia prices metal higher than London or New York, it exposes which market is anchored to physical demand versus leverage. China, India, and Gulf states tying infrastructure and solar supply chains to silver isn't speculation, it's procurement. Meanwhile, Western exchanges still price metal through paper claims that can expand infinitely. Export controls since January quietly tighten supply, but headlines frame this as regional demand. For investors, this gap signals where price discovery is migrating. Mario Innecco's next point explains why paper benchmarks may be forced to adjust.
And yeah, I think it's about $10 premium over in China. And then you can also, I mean, when you take delivery in China, you pay VAT. But Eric Young, who's also known as King Kong, he does a very good job of differentiating the price with VAT and the price without VAT. And even without VAT, I think silver's trading around $100. I think today it's sell about 101 on the Shanghai Gold Exchange. So that's why it's happening. It's because it's a real physical market in the Middle East and the Far East and in India, while here in the West, it's still kind of a hybrid, but eventually I think there's no way that the price in London and New York won't catch up to the price in China or even India. I think there's a 17% premium.
Premium isn't noise. It's a warning label. As Mario Innecco notes, sustained premiums of 15 to 20% don't persist unless supply is genuinely constrained, and Shanghai pricing near $100 confirms that disconnect. VAT-adjusted figures strip out tax distortion and still show physical buyers willing to pay materially more than Western spot prices. That tells long-term investors something critical. Futures pricing may understate replacement cost. When convergence happens, it usually isn't Asia falling. It's the West repricing upward. What Mario Innecco points out next shows how this gap can close abruptly.
It is interesting, the different dynamics with the physical versus the paper market. And we keep seeing from the CME margins being raised. And now just this last week, they've changed it to you need a percentage of the total value in your account instead of, just a nominal amount. So that's kind of, if silver continues to rise, that's kind of automatically raising margin requirements in some sense. And I believe it applies to the longs and the shorts. So in some sense, I almost feel like it's making it more a fair market in that regard, because you can't just be playing the casino. Your perspective on the continually raised margin requirements from the CME?
Well, I guess you could argue that it helps the bullion banks because they're mostly short. So if the price goes up, well, they will need more, I guess, margin. But also the longs, if the market goes their way, they will need more margin. But like you said, you're right. It's fair because the bullion banks are going to be losing more and they're going to have to pay more. So yeah, it would punish them more. You're right. And in the end of the day, we might see COMEX become almost a physical market.
Margin hikes aren't about fairness. They're about containment. As Mario Innecco points out, exchanges raise margins when volatility threatens the system, not when markets are healthy. Tying margin to total contract value quietly throttles leverage as prices rise, forcing weaker hands out regardless of direction. This hits bullion banks too, but it also suppresses speculative upside by design. When leverage is squeezed, paper volume shrinks and physical relevance grows. That's how a derivatives market slowly loses control of price discovery. Mario Innecco explains next why this shift could accelerate faster than expected.
If they keep raising the margins and the margins keep getting bigger, but the other thing as well, I think an exchange, and I'm giving them some credit here, an exchange needs to make sure that it's not in danger of bringing down other counterparties in the exchange because of volatility. And I think that's why they raise the margins usually, because of the volatility in the market.
The markets are recognizing that the Fed's independence is kind of shaky. Trump has really been pressuring the Fed over the last, I guess year really, since he's been in office. And right now, just in the last couple of days, we've heard that he's actually, the DOJ is going to be investigating Powell. So your perspective on this, kind of the president's and the government's pressure on the Fed at the moment and how it's impacting precious metal markets?
Yeah, I think for Wall Street, and I've read about this, a lot of the major players on Wall Street, from banks, fund managers, they say it's a dangerous situation because it, how can I say it? It chips away at the Fed's independence to set rates as they're supposed to contain inflation.
Markets aren't reacting to margin hikes. They're reacting to a power struggle behind the curtain. As Mario Innecco points out, margin increases often signal systemic stress, not prudence, especially when volatility stems from political interference rather than fundamentals. Wall Street fears aren't about Powell personally. They're about precedent. Because if central bank independence erodes, rate policy becomes politicized. Historically, precious metals respond when confidence in monetary governance weakens, not when inflation data ticks up. Investors should read this as a credibility issue, not a policy tweak. What Mario Innecco explains next reveals why this pressure matters more than headlines admit.
Even though, Elijah, I think the Fed is an inflation machine, but the majority of people in the markets and on Wall Street think otherwise. But that's a different topic. So yeah, it's seen as infringement on the Fed's independence, and people worry that if Trump or the DOJ really goes after Powell, it gives a really dangerous signal in the future. It's not totally just about Powell, is about the next Fed chairman or chairwoman. They would be thinking twice before doing something radical to perform, the objectives that they should follow from Congress of maintaining price stability and full employment. So yeah, it's a danger, and I think it's one of the reasons why. Not the sole reason, because gold and silver were doing well anyway prior to the announcement from the DOJ. Yeah, and I know Trump has been pressuring Powell, but he's kind of left him alone right now. And but even if we didn't have this attack on the Fed by Trump, I don't think the fundamentals for gold and silver or precious metals in general would change, because the underlying problem we have is too much debt.
The real risk isn't who runs the Fed. It's what constraints they operate under. As Mario Innecco notes, markets fear a future where central bankers hesitate to act decisively because political retaliation is now plausible. That uncertainty alone raises the appeal of gold and silver as policy-agnostic assets. Even before DOJ headlines, metals were rising alongside expanding deficits and weak real yields. For long-term investors, this reinforces that metals aren't a trade on politics, but insurance against structural debt overload. Mario Innecco's next point clarifies why debt, not drama, drives this trend.
And that can only be serviced and sustained by even more debt being issued, or more reserves or money being printed by the Fed, and more borrowing done by the U.S. Treasury, by the U.S. government. So I don't think fiscal policy and monetary policy are going to go tight anytime soon.
One of the things that is interesting in all of this is it's kind of funny to talk about how, the markets are saying, this is a bad thing that the president is pressuring the Fed. At the end of the day, it just seems like kind of a huge mess in my mind, because I think you and I probably don't even think the Fed should exist, and we should be on a sound monetary system. And this idea of thinking that an independent Fed is a good thing, I think kind of misses the whole point.
Of course, because most people are oblivious to the Fed's history. They probably think the Fed's been around since 1776 or something like that. So that's why. For you and I, it's like, go ahead and go after the Fed. It won't make any difference. You just have to look at a chart of M2 since 1971. It's going parabolic. So the Fed is doing a really bad job on inflation already.
This debate misses the forest for the trees. The system is locked into expansion. As Mario Innecco points out, debt saturation mathematically prevents sustained tightening, regardless of who occupies the Fed chair. Since 1971, M2 growth has accelerated in waves, each larger than the last, confirming policy dependence on liquidity. Calls for independence sound hollow when outcomes remain the same: more borrowing, more printing. For investors, this explains why hard assets outperform across decades, not cycles.